You know, it is extremely rare to see a day where the market gets hit by two entirely different massive shocks at the exact same time. Usually, a shock in the semiconductor market combined with a geopolitical oil shock is enough to make the entire market run for the exits. But today, something truly fascinating happened beneath the surface.
It really did. The money didn't just evaporate, and it didn't rush entirely into cash. It actually just moved. We saw a massive, aggressive deleveraging in the high-flying semiconductor names, combined with real geopolitical stress in the Middle East, yet the capital quietly rotated right into software.
Welcome back to the Working Thesis. I'm Maya.
And I'm Theo. It's Tuesday, July 7th, 2026, and today we are unpacking what we are calling the double shock to the system. On one hand, we had the severe second wave of a hardware and memory sell-off. On the other, inflation fears woke right back up, thanks to a sudden spike in crude oil.
And yet, if you only looked at the surface-level panic, you would miss the real structural story playing out. The most important takeaway today is not just what got sold in a panic, it is what was actively being bought while the selling was happening. Let's get right into how it all played out on the tape today.
First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud. Personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. Let's start with the broad strokes of the scoreboard. How did the major averages handle these massive cross currents today?
They definitely took a hit, but honestly, it was a very orderly retreat rather than a broad systemic panic. The Dow Jones Industrial Average shed 0.25%, stepping off its recent 53,000 record to close at 52,925. The S&P 500 gave up 0.45%, but importantly, it held that key 7,500 line, finishing at 7,504.
The heavier damage was concentrated in tech and the small caps, right? Because they took the brunt of the repricing.
That's right. The Nasdaq Composite dropped 1.16% to finish at 25,819, and the Russell 2000 fell 0.9%, actually losing that psychologically important 3,000 level in the process. But the real epicenter of the selling was isolated in the hardware space. The Philadelphia Semiconductor Index tumbled about 4.65%, and if you track the SOX ETF, it was down a very steep 5.1%.
A 5% drop in the semiconductor space is a serious localized earthquake. But despite that concentrated pain, volatility isn't exploding across the board.
Exactly. The VIX did tick up 3.6% today, but it is sitting at just 16.1. That tells us the options market sees this as contained repricing and a managed sector rotation, not the start of a broader structural market crash. Let's drill deeply into that semiconductor earthquake, because this wasn't just a gentle trim off the top. This was the severe second leg of a major hardware and memory deleveraging event.
It absolutely was, and the carnage was incredibly widespread across all the major names in the space. Micron fell 4.7%. Applied Materials dropped 6.5%. ASML was down 4.3%. And Marvell took a very heavy 7.5% hit by the close.
It didn't stop there. Even the massive foundational giants weren't spared from the selling pressure. TSMC pulled back 4.3%, and Intel took a massive 9.7% plunge today. The institutional selling pressure across the entire complex was intense from the opening bell right through to the final minutes of trading.
What is striking here is that it is a completely uniform de-risking event. Investors are simply stepping away from the hardware space entirely right now, regardless of any individual company's specific product mix or long-term market position.
Right. When you see an index like the SOX down over 5% in a single session, that's not about individual corporate execution or missed earnings. That is institutional capital broadly and forcefully reducing its overall exposure to a very crowded trade. The leverage that built up around the semiconductor supercycle over the past year is being aggressively unwound.
The most fascinating part about this semiconductor sell-off is the context in which it happened. It didn't happen because business is suddenly bad or because orders are being canceled. In fact, we got the exact opposite signal out of Asia overnight.
We did. Samsung reported an absolute blowout quarter. Their profit was up roughly 19 times year over year. That is a staggering, record-breaking number that explicitly confirms the underlying AI and memory cycle is still operating at full capacity. And how did the market respond? The stock still fell.
It fell so hard, it actually triggered a circuit breaker on Korea's Kospi index, which ultimately closed down 4.9%. Japan's Nikkei also tumbled 3.4% in tandem. When a company posts a 19x profit jump and gets aggressively sold anyway, that tells you everything you need to know about where positioning is right now.
Exactly. This is the clearest tell we have in the market today. This is definitively not a demand issue. Demand for these chips is clearly fine, if not stronger than ever. The issue is that the market is simply done paying up for crowded, priced-for-perfection hardware stocks.
Right. When the fundamental news is that incredibly good and the stock still goes down aggressively, it means all the good news was already baked into the price, and then some. It is a positioning reset, pure and simple, prioritizing diversification over momentum.
But here is the massive silver lining, and really the star of the entire day. While the semiconductor complex was cratering under its own weight, the broader AI and tech trade did not break. The capital just rotated.
And the rotation held beautifully across the board. NVIDIA actually managed to fight the tape and close green, up 0.7%. But the real story was enterprise software. Microsoft added 0.5%. Meta was up 2.6%. ServiceNow gained a very strong 2.6%. Salesforce was up 2.3%, and Palantir finished higher by 1.4%.
That is the crucial divergence that everyone needs to be paying attention to. You have enterprise software massively outperforming semiconductors for a second straight session. When you see big cap software names putting up 2 to 3% gains on a day when the Nasdaq is down over 1%, that is a glaring signal.
It tells us this rotation is actively confirming it is not a one-day fluke. Capital is looking at the AI trade, deciding that the hardware side has gotten too expensive, and deliberately moving that money directly into the application and platform side of the equation.
Which is exactly what a healthy, functioning bull market does. It corrects excesses by rotating, not by indiscriminately crashing. The underlying AI thesis remains fully intact, but the market's preferred vehicles are dynamically shifting.
While that tech rotation was playing out, we had a very real, very severe geoeconomic shock hit the tape globally. Iran attacked 3 ships in the Strait of Hormuz within a very tight 24-hour window.
Yes, this is a significant and immediate escalation. The attacks targeted a Qatari LNG carrier and Saudi tankers. Iran is now explicitly demanding that all commercial ships use an Iran-controlled channel to transit the strait. Consequently, the international maritime threat level has immediately been raised to severe.
And Washington responded instantly by reimposing strict Iran oil sanctions. The market reaction to all of this was swift and entirely mechanical. WTI crude oil jumped roughly 3 to 4% as supply disruption fears instantly priced into the curve.
This naturally rippled across the asset classes. Energy equities obviously rallied hard on the back of the crude spike. But interestingly, gold actually fell about 1.2%, and treasury yields rose simultaneously.
Which tells us exactly how the bond market is interpreting this event. The rise in yields alongside the jump in oil suggests this is being heavily treated as an oil-driven inflation scare, rather than a broad economic growth panic. It is fear of inflation waking back up, rather than fear of an imminent recession. Keep it strictly factual. This is about supply lines, not politics.
That inflation scare created some incredibly wild cross-currents when you look at the sector map today. It was decidedly a risk-off day, but it came with a very specific structural twist.
Right. Energy was the most obvious winner, up about 2.8% on the back of that crude oil spike. But we also saw a very strong, sustained bid for defensive sectors. Healthcare, utilities, and real estate all caught heavy institutional flows today.
Meanwhile, technology was the major laggard, down 2.4% overall, heavily dragged by those semiconductor names we discussed. And the broader cyclical sectors also fell back as the market aggressively absorbed the geopolitical headlines from the Middle East.
The cross-currents were truly fascinating to watch unfold. You had bond proxies like utilities and real estate catching a traditional risk-off safety bid. But at the exact same time, the inflation angle from the oil shock was actively pushing Treasury yields higher.
It is an incredibly rare setup. Usually, rising yields act as pure kryptonite for utilities and real estate. The fact that they rallied anyway shows just how much institutional cash was actively seeking safe havens today, completely overriding the mechanical pressure of higher yields. It was a day where capital preservation simply took priority over pure rate logic.
Beyond the daily price action, there is a very serious structural conversation happening right now about the underlying plumbing of the AI build-out, specifically how all of this infrastructure is actually being financed, and it is raising some notable fragility questions.
That is exactly right. A widely cited industry analysis published by SemiAnalysis dropped a rather stark warning today. They estimate that the debt burden of these so-called neo-cloud GPU rental firms could potentially top $7 trillion within the next 3 years.
That is a staggering figure. And the crucial wrinkle they highlighted is that NVIDIA is increasingly acting as a financier within this ecosystem. They are effectively backstopping the GPU rental prices to keep the whole machine moving. It is a dynamic that raises serious durability questions about the underlying plumbing.
We actually saw the market digest that specific risk today. The major rental names took a hit. CoreWeave dropped 3.4% on the session, and Navius fell 8.4% as investors started pricing in that specific financing fragility.
But the paradox here is that the overall capital appetite is still absolutely ravenous. Look at what happened on the mega-cap side. Amazon just launched a $25 billion bond sale, specifically earmarked to fund its massive AI infrastructure push.
Exactly. So the takeaway here is definitely not that capital expenditure is slowing down. The CapEx is still accelerating across the board. The fundamental shift we have to track is that the build-out is increasingly being debt-funded, which introduces a very different kind of financial physics into the system. Speaking of the physical infrastructure required for all this AI compute, let's talk about the power side of the equation, because we got a major supply-side development in the nuclear space today that shouldn't go unnoticed.
We certainly did. Cameco formally announced they are suspending operations at their Cigar Lake mine. That represents a massive, immediate removal of supply from the global market, and it constitutes a serious tightening of global uranium availability.
Fundamentally, that is incredibly price-supportive for the raw fuel. It creates a structural deficit. However, because today was such a broadly risk-off tape, the equities didn't immediately reward the news. The nuclear-linked power names actually pulled back in tandem with the broader market.
Right. GE Vernova dropped 6.5%, and Bloom Energy was down 8.6% today. The overarching selling pressure across industrials and tech just dragged them down, completely ignoring the bullish fundamental supply shock from Cameco.
It is one of those classic market disconnects. The physical commodity market for uranium just got significantly tighter today, which makes the long-term thesis for these power providers even more robust. But the stocks themselves took a short-term hit from macro-driven algorithmic selling.
So, stepping back from all the daily noise and cross-currents, we have to ask the big question. Is this chips-to-software rotation the real thing? Or is it just a temporary distortion in a messy week?
Here's the read on that. When a rotation survives a day where semiconductors drop a massive 5%, and it simultaneously absorbs a fresh, severe geopolitical oil shock in the Middle East, that looks incredibly structural to me. It does not look like noise.
I completely agree. The sheer resilience of enterprise software today, holding green while the Nasdaq takes a hit and chips crater, is incredibly telling. It really looks like sticky money, willfully leaving expensive hardware and migrating into comparatively cheaper enterprise software platforms.
But of course, we always have to apply the humility line here. This is purely a likelihood game. No one can predict the future with absolute certainty. This is just one read of what the setup looks like today, based entirely on how the capital is actually moving.
Exactly. You have to respect the tape. And the tape right now is clearly voting that the next leg of this AI cycle is going to be increasingly driven by the application layer, not just the physical silicon.
Looking ahead to tomorrow, Wednesday, July 8th, we have the major macroeconomic catalyst for the week. The FOMC meeting minutes are officially dropping.
And they are going to land in a very sensitive, precarious environment. Inflation expectations are quietly ticking up again. The New York Fed survey just showed one-year inflation expectations rising from 3.5% to 3.7%.
That is exactly why the market is going to aggressively parse every single word of those FOMC minutes for a hawkish tilt. With oil spiking today and expectations creeping higher, the Fed's exact tone on sticky inflation is going to be front and center for every institutional desk.
Beyond tomorrow, we have a few other massive items on the horizon. TSMC's earnings are coming up around July 16th, which will serve as the next major fundamental data point for the entire hardware cycle.
Plus, we have to closely monitor the ongoing situation in the Strait of Hormuz, which could continue to heavily pressure global energy markets. And running in the background, we are tracking SK Hynix's roughly $29 billion US listing, which is going to be a colossal capital event for the global memory space.
Let's bring it all together for the net thesis read. First, power remains the absolute binding constraint on AI development, and the global uranium supply just got significantly tighter today with the Kimako suspension.
Second, semiconductor demand is stronger than ever. Samsung's record numbers prove that fact overnight. But the market mechanics have fundamentally changed. Priced for perfection chips are being aggressively sold, and that institutional money is definitively rotating into enterprise software.
Finally, the one node we have to watch carefully is the NeoCloud financing fragility. The sheer volume of debt backing these GPU rentals is becoming the visible weak link in the build-out's underlying plumbing.
But importantly, none of our core thesis kill criteria fired today. The structural trends remain fully intact, even as the specific winners rotate. That is the wrap for today. The cross-currents are intense, but the underlying direction of capital remains incredibly clear if you know where to look.
Thanks for joining us for another walk through the markets. As always, stay curious, and we will see you back here tomorrow for another update. Have a great evening.
And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.